Sorry, I was muted. I just want to make sure that I introduce these two gentlemen. They are amazing, the best in the business. Jason is a financial planner. And again, I apologize if I slaughter all the titles and things that you guys have worked so hard for. I'll give you an opportunity to correct me. And Cody Melton is a tax planner and preparer. And I want to let you guys know that these are the gentlemen that I trust my family with. And so I trust my friends with them as well. And they have graciously agreed to use their time today. They are both very busy in these markets, and they've graciously allowed us to take a little bit of time. So I'm going to start with Cody. If you will just take a minute to introduce yourself, correct anything that I said inappropriately, and then I have some questions for you in hopes that you can answer them for us.
Yeah, sure. Thanks, Jill, for allowing me to join you in this. I know there's a lot of uncertainty in today's time with this coronavirus, and so I'm glad that we can join and hopefully calm some nerves and give some people some good information. Like Jill said, my name is Cody Melton. I am a co-owner of an accounting firm up in Oklahoma around Grand Lake in a small town called Grove. And we primarily work with individuals and small businesses to obviously help them with their tax preparation, but also go a little bit further with their tax planning. And then for small businesses, we do the core accounting functions such as, bookkeeping, accounting, payroll, all of that good stuff. So just your typical accounting firm, we utilize the technology as much as we can, such as Zoom. We can do these virtual meetings and utilize cloud-based solutions so that we can keep everything streamlined and focused. So, you guys can do your jobs, we can do our jobs and all that good stuff. So it's a little bit about us.
Okay.
And yeah.
All right. So I'm going to just jump into the tax related questions for you, Cody.
Okay.
The first one is it true that our taxes are delayed until July? And if so, should we wait to pay them or pay them now if we can?
Yeah, that's a good question. So the government just passed this this relief for tax payments. So there is some confusion in that. So we got to make sure that we get this straight. Is that the tax filing deadlines do remain to be April 15th, but the tax payments are delayed 91 days. So it's to July 15th. And so this is all in efforts to keep about $300 billion within the American economy. And so this applies for most individuals. It's probably going to apply for everyone here today. But everybody who has a tax liability of $1 million and under are affected by this. And then for everybody who is a corporation, that is going to be for everybody $10 million and under. So yes. If you guys have a state that has state income taxes, be sure to check with your state. I know for our state of Oklahoma, we do have state income tax. It does not go along with this. Our tax filing deadline and the payment deadlines for the state of Oklahoma still remain to be April 15th. So be sure to check on your state.
Okay. Any tax tips for us either during the quarantine or afterwards? Things that we should be looking as write-offs or things to sort of, have on our minds during this time?
Yeah, so with all of you that are self-employed, you're going to still have your ordinary business expenses that are going to be deductible to you. And during this time, you may have stocked up on any supplies within your office. Those would continue to be deductible. It's a good time to start your tax planning because, if you are stocking up on office supplies, that is a good, healthy write-off for our small business owners. For those that are individual and not self-employed, there are still minimal tax deductions available with the increase in the standard deduction that had come with the new Tax Cuts and Jobs Act that came into effect in 2018. You still have your ordinary real estate taxes, mortgage interest, your charitable contributions. You still have medical expenses. I know a lot of us may have medical expenses if we're affected by the coronavirus. So make sure that you keep receipts on any out-of-pocket medical expenses. You can even keep track of your mileage when you go see your doctor. So a lot of those do apply.
Okay. And the next one is, do you foresee that there will be more than just an extended deadline? Will there be any cuts or relief for small business owners or anything sort of related to coronavirus into the 2020 tax season?
Yeah, it's a good question. So there are bills being introduced to Congress, and so there's nothing yet passed. So there's a lot of uncertainty regarding this. But the rumors are that there are going to be stimulus packages for small business owners. We just don't know in what form. We believe that this is going to be for those who do have employees, because we see a lot of employees taking sick time, or the employers are sending their people home to stay quarantined so that they're not affected. So the government may be producing bills to help fund that effort. So at this point, it's too early to tell, but we'll keep an eye on that.
Awesome. Thank you so much for answering that. Does anybody have any questions for Cody before we switch over to Jason? Any tax related questions? I was glad to hear about the filing deadline being different than the payment deadline, because all I had heard is that it was postponed until July, but I'm glad you clarified we do still have to file on time.
Correct.
Any questions?
I'm just going to shout out because I think that's Rachel and Jenna, which are both people that I invited. So just quickly, what I believe was said was that the tax deadline is still April 15th to turn everything in, but any payments due, that is July 15th. Is that correct?
That is correct. The payments only, if you're under $1 million, yes, payments only will be due July 15th.
Okay, thank you.
You're welcome.
All right, then I'm going to pass it over to you, Jason. Thank you, Cody. And if you want to introduce yourself, because I have no doubt I missed all the important things about your titles. So please reintroduce yourself to us, share a little bit with us about what you do, and then we'll get into some questions.
Sure. Thanks, Jill. So again, my name is Jason Penny. I founded a financial planning and investment advisory firm here in Oklahoma City about 6 years ago. I've been in the investment business for a little over 15 years. I guess it'll almost be 16 years coming up here later this summer. But I've been in private practice for about 6 years, and we primarily work with individual clients and business owners around doing comprehensive financial planning. A lot of firms work more specifically just within the realm of investment management. Now, there's nothing wrong with that. We take a little bit of a different approach, and regardless of what your income is or how much you have in investments, we believe everybody should have a comprehensive financial plan that hits on what we believe to be the 6 to 7 core areas that most people are dealing with from a financial perspective. But yeah, we really work with people to try to customize and individually tailor plans for them and their families, and really take a big interest on helping them mitigate risk with the use of insurance-related instruments, and then ultimately try to help them put together investment plans that are tailored to them and their families to be able to hit their long-term goals. And so that's really the focus of our practice, and what we kind of get up to do every day.
Awesome. So we have a few questions for you as well, Jason. I'm going to go ahead and start with the first one. We're seeing on the news that the markets are plummeting, and the safety buzzer has gone off 4 times or more in the markets. Can you tell us what that actually means?
Yeah, what that safety buzzer terminology is actually referring to is what the industry calls a circuit breaker. And what that really means is that there are some mechanisms in place with the market in which as momentum picks up, when the market is trending downward, those mechanisms are in place to temporarily halt trading on those exchanges, so that we don't continue to see dramatic extended losses in a single one-day period. And so what happens there is there are electronic mechanisms that are in place that see the overall trading trend in the market, and as it goes down, those circuit breakers will trip at a couple of different measures. The first one happens at a 7% loss of the overall market. The next one happens at a 13% loss, and then ultimately the last one is at 20% loss in any one particular day, and it halts for about 15 minutes. So in any 1 day time frame, if there's a 7% loss in the overall market, that level 1 circuit breaker will trip and market trading will be halted for about 15 minutes. And then it picks back up again to see what happens. And then if that halt kind of stems the overall downward trend, then trading will go on as usual for the rest of the day. But then if it hits that 11%, or excuse me, the 13%, or then again at the 20% in that one particular day, those temporary halts will take place again. But again, we're only talking about if that's happening within a single market day's worth of trading. So
Okay.
that's what that's referring to.
Okay. The second question is, should I even look at my retirement account right now? And should we look to make changes or leave it alone? And is that the same if you're a 20-year-old versus a 60-year-old?
Yeah, that's a great question. It's one that I've been answering a lot lately over the last couple of weeks. And I think the short answer to that has everything to do with how old you are and when it is that you're expecting to be able to need to access the money that you have in the market. So I would definitely say yes, it's very different if you're a 60-year-old and anticipating retirement within a couple of years compared to if you're a 20-year-old. You know, most people expect to retire somewhere between age 60 and 65. So if you're 20 and you've got a 45-year time frame in which you anticipate needing access to that money, the short answer would be no. There's really no good reason to be looking at your investment accounts or your retirement accounts unless you're just curious. But I would say that if you're working with an advisor, or if you've done a really good job of managing that yourself and you have an appropriate investment allocation, or if you're appropriately investing in different types of securities that are particular to your own individual risk tolerance, then no, there's no real good reason to do anything just because of this downturn as a result of the coronavirus. If you're 60, on the other hand, and you're anticipating a retirement in the next couple of years, or certainly within the next 5 years, then yes, I would say that you need to be visiting with your advisor if you have one. If you don't have one, I would definitely recommend getting with someone who's a licensed professional in that particular area and working with them to determine what, if anything, you should be doing, because again, it has everything to do with how your investments are currently positioned right now. If you're really, really risky and you've got a lot of your money invested in equities or in the stock market itself, then yeah, you might want to be looking at making some changes. If you have more money in fixed income or bonds in the bond market, then you may not need to make a lot of changes. But again, that has everything to do with your time frame and what your own individual risk tolerance is. But that's a great question.
Okay. The next question, President Trump says that after the virus, we will bounce right back. What does that mean? And what is your opinion?
Yeah, I think what he's referring to is really just the strength of the overall economy. Interestingly enough, I know that things change so rapidly, but prior to about the last 3 weeks, we actually saw economic expansion or growth in our economy, both in the months of January and February. So for those that don't know, the market reached an all-time high at just over 29,000 on February the 19th. And so by all measures, our economy was super, super strong. And I think what he's referring to is that until this virus pandemic started really getting people so fearful, the fundamentals of our market and the fundamentals of our economy are very, very strong. And I refer to an economist that I follow and track on a regular basis. His name is Brian Wesbury. He's the chief economist for First Trust Portfolios. If you don't know who that is, I would definitely recommend that you follow him on Twitter at Wesbury, and that's Wesbury, Brian Wesbury. He looks at there being 5 pillars to the economy, And even up through about 2 or 3 weeks ago, 4 out of those 5 pillars remained fundamentally strong. So when the president says he believes that we're going to bounce right back, I think what he's referring to, this scenario is in no way even similar whatsoever to the market downturn that we saw in 2008 as a result of the financial crisis. At that time, the fundamentals of the market were very unstable, which led to the recessionary period that we went through. This scenario with the coronavirus, on the other hand, is very, very different. Our fundamentals in the economy are still really, really strong. The only one that is a little bit unknown right now is our trade policy. But if you're following how that works, that's a daily difference in who you believe. But I think what the president's referring to is once this panic subsides, the fundamentals of the economy are still going to be very, very strong. And I personally believe that the president is correct, not trying to be political, but strictly from an economic standpoint, I believe we're going to see a V-shaped market recovery, where in essence we'll have gone down and then it's going to come right back once this panic subsides.
Okay, awesome. What should I be doing to be preventative of more losses or to protect my current nest egg?
Yeah, that's kind of a tough question to answer. It's difficult anyway in a general sense. In our practice, we work with individuals based on their own individual circumstances. But in a general sense, again, I would refer you to work with a professional who knows your situation. But there's really only a couple of things that you can do. Again, if you're one of those people that are closer to a retirement age, I would say that based on where we are with the economy, I do feel like overall it's going to be fairly strong coming out of this pandemic crisis. Again, that's really driven and fueled by fear. But yeah, if you're closer to retirement, I would say go ahead and continue to make contributions, because even though in the short term the market's off about 20 to 35%, or excuse me, 25 to 30% over the last 3 weeks or so, that it's like going to your favorite department store or going to the grocery store and finding some of your favorite foods on sale at 30% off, right? You're not going to go to the grocery store or to your favorite department store and find something that you normally like to purchase that's 30% off and then decide not to do that. In reality, what most of us do in that type of situation are, yeah, we're going to take advantage of that sale. And we might even buy 2 or 3 of the thing that we really like because it's at such a discount. I would liken the situation to your 401k or your investment account very similarly, in that as long as you're taking the proper risk and you have the right investment allocation, continue to make purchases into those accounts, because when we see this correct itself and come back up again, which I believe is what's going to happen, then you're going to be rewarded for that. And there's opportunity in the market right now. If fundamentally you have a different view, or that your gut just tells you that you don't want to continue to invest in the market, then you can continue to make contributions, but change the allocation or change the investments that you're going to be putting that money into. So what I mean by that is, if you're buying regularly into stocks or stock mutual funds that are going to be more risky and more volatile, maybe you change those contributions in the future to go into more conservative investments like bonds or bond mutual funds, or even cash if you're really, really concerned about it. And that would be one of the things that I would recommend that you could do to stem any future losses. The other thing I'll say about trying to limit loss in your existing investments, if you've got a fairly long time horizon, I would not recommend doing that on a general basis, because it's kind of a self-fulfilling prophecy. And what I mean by that is, right now, the losses that you're seeing, if you're looking at your 401k or your investment accounts, they're only on paper. They're not what we call realized gains or losses. Right now, they're just unrealized losses because you haven't actually sold out of those investments you currently own. So when people get fearful and they're worried about what's going to happen, if they go in and they place trades to sell out of those investments, in essence, they're self-fulfilling the prophecy of being fearful, and they're going to lock in those losses. And that decision itself is really difficult. The other, in my opinion, more difficult decision is once you sell and you go to cash, when do you reinvest? When do you get back in? And that's the really difficult thing. So again, work with a professional that knows your situation, that can address your specific needs, but I would caution against making any reactive changes to what you're doing right now until you get a really, really firm understanding of what the impact to those changes might actually mean for your investments.
Okay. Jason, do you have the ability to show us that graph that you were sharing with me, or are you not able to share that?
Yeah, no, I can certainly show you.
I think that would provide some calm, and it really just was very informative for me. I think that was some great information, if you don't mind sharing it.
Absolutely. And guys, what Jill's referring to is as we were kind of preparing for today's call, I showed her and Cody a graph, and I'll share it with you guys right now through a screen share. And basically what this is this is a chart that looks at the market dating back down here in the bottom quarter to 1925. So based on that time frame of 1925 to 2020, we're looking at a 95-year history of the market. And there's a lot of stuff on this chart. It's super, super busy, but I'll try to condense this down and make it fairly easy to understand. But in essence, all of these lines that are going up here, these squiggly colored lines, are simply showing the movement of what occurred in different areas of the market with what was originally a $1,000 investment in the stock market in 1925. So what this is saying is, if you'd made a one-time investment of $1,000 in 1925 and you never touched it, meaning you never took any money out, but you also never put any money back in or added any contributions to it, what happens is you see these different periods of time. So here's the Great Depression, World War II, inflation hit a super high mark at over 19.5%, the Korean War, where the Dow 500 was introduced, the first credit card was introduced into our system. You had a bunch of different stuff go on here, the Vietnam War, oil embargo crisis, you had the first index funds. Here's Black Monday in 1987, the first Gulf War. Just looking at other periods here, this drop right here you see was the 2008 subprime lending crisis, those kinds of things. But over that 95-year period of time, let me kind of move my screen over here a little bit so I can see what I'm talking about. If you had just invested in what we call a TIP, or Treasury Inflation Protected Securities, it's really just investing in your money growing at the rate of inflation, which was an average of 2.9%. Your $1,000 investment in 1925 would have come out to be about $14,400 today. Treasury bills, we see a little bit of an improvement at an average of 3.7% return to get you to $29,000. Straight bond portfolio would have been around 111 at an average of 5.1. An income-based portfolio that's going to be comprised of a combination of bonds that kick off interest and dividend-paying stocks would have been around 371,000 with a 6.5% average. International stocks, those stocks of companies that are held outside the U.S., 1.2 million. A balanced portfolio, which is represented more of like a 50-50 mix of stocks and bonds, would have been almost 1.7 million at 8.2. If you would have looked at a growth portfolio where you probably would have had a combination somewhere of between 70% stocks and 30% bonds, even up to maybe an 80-20 mix of stocks and bonds, would have been almost 4 million. But if you had just invested purely in stocks, the S&P 500 that entire time, from a $1,000 single investment, your money today would be worth over $8 million.
Oh,
And what this is really trying to show people is that the market is efficient, and this is not the first crisis we've encountered as a country. It's not the first time that the market has encountered a crisis. And so dating back to all those different really, really critical issues that we've faced back to 1925, Black Monday, the Vietnam War, World War II, the Great Depression, so on and so forth, the markets have never had a 10-year rolling period that was negative. Meaning that if you started in 25 and went from 1925 to 1935, and then from 1926 to 1936, and so on and so forth, there's never been a single 10-year period in which the market has been negative. So hopefully that will provide you guys with a little bit of confidence around not freaking out, not making major changes in your investment portfolios without talking to a professional, in which they could recommend, based on your own individual situation, doing something different than you're already doing.
Awesome. Thank
Okay.
you for sharing that, Jason. We have one last question, then I'll open it up to anybody that has questions on the call. The last question is, in reference to the cash in our bank accounts, do we need to worry about taking out cash, or how is the bank structure during this time?
Yeah, I've not heard anything with regard to there being a run on the banks, like what some people may have heard. At least locally here, I've not heard of that. I've not seen anything on any of the social media accounts that I follow in our business, which, Facebook, Twitter. Twitter really is a great resource for a lot of financial data. If you're not on Twitter, I think Twitter does a great job of getting out news and major market and economic news in a very timely basis. But I've not seen any of that type of information coming through those mediums at all. I know that my mom, she was telling me over the weekend that she had gone to her bank here in Oklahoma City late last week. I think it was on Thursday or Friday. And the teller that she visited when she went to cash her check said that they just happened to be out $100 bills at the moment. But I don't think that was indicative of there being a run on the banks. And I know that Cody shared a pretty interesting situation that he had encountered one of the local bankers there in Grove. Cody, if you want to kind of share that too, I think that would help provide some perspective as well.
Yeah, I had to go over to a local bank here, and this is a really small bank. It's not like a national chain or anything. This is a local bank here at Grand Lake that has a couple locations, and I had to go over there with the client meeting. And so I asked the bank employee, who is fairly high up in that bank, if they have seen a lot of individuals come in here wanting to pull out cash to stock up and just pull it out of the bank for uncertainty. And she said they really haven't seen any of that at this point. So that was a good thought in my mind. So that's kind of what we're experiencing up here in Northeast Oklahoma.
Awesome. Okay, so I'm going to open it up for questions for Jason, or if anybody has thought of any questions for Cody, now is the time. You guys are welcome to unmute yourself and ask any questions you have.
So I am currently using like the snowball method of paying off debt. And so a certain portion of my paycheck every 2 weeks is allotted to that. Do you think that for this like very specific moment in time that I should reallocate that money to a savings fund?
So I think that has a lot to do with how much cash you keep on hand. In our practice, when we're working with individual clients on long-term comprehensive financial planning, one of the very first things that we talk about is what that client's liquidity looks like, or in more common terms, how much cash can they get access to within a very short period of time. So having an emergency fund is really, really important. I would say that based on our recommendation, we always tell clients that, in our opinion, they should have somewhere between 3 and 6 months worth of their basic living expenses in a liquid savings account that if at any given time, for any given reason, they needed to get access to it, they could. Now, we do that based on a lot of the risk mitigation that we do with clients to help protect against an interruption in income, particularly from a disability event or if they lose a job, right? So thinking in those terms, if you were to lose your job and you did not have income, we recommend that clients have about 3 to 6 months worth of those basic living expenses on hand. So with that being said, if you're fairly confident with your liquidity position and you feel like you've got enough money already in savings to help protect against a loss in monthly income, I would say go ahead and continue to make those payments to your debt, because over the long term, I think this is going to be a very short-term event. I don't see this being a prolonged scenario in which we should start to hoard cash unless you don't have a cash position already on hand. So depending on where that income is coming from, and if you're a Plexus person, I could see there being some potential interruption, not from a total basis, right? But if people stop buying product or what happens, I could see the income being affected somewhat from Plexus. But if you feel good about the amount of money that you have on hand to be able to take care of your basic needs, I'd say go ahead and keep making your payments just like you normally are. If you don't have any cash on hand, I would say in the short term, it probably wouldn't be a bad idea to reallocate those debt payments to an emergency fund if you don't already have one.
Okay, thank you.
You're welcome.
Any other questions? Okay, then I'm gonna ask one final question of both Cody and Jason. How do they get in touch with you if they are looking to work with someone personally? How do they contact each of you?
Yeah, so you can contact our firm at our phone number is 918-786-3292. We also have a web address that is www.tcadvisors.net. And there is a contact us form on our website. Also, my email address is Cody, first name Cody, C-O-D-Y, at tcadvisors.net.
And you guys can get in touch with me if you'd like to have a conversation. Probably the best way to do that is through my email address, which is jpenney, and Penny is spelled P-I-N-N-E-Y. So that's jpenney@financialguide, GUIDE.com. I'll even give you my cell phone number too. That's something that we do on a pretty regular basis, just because we want to make sure that people know that we're accessible. But my cell phone number is area code 580-761-3127. And I'll go ahead and give you our web address as well. But I will tell you that we're currently updating our website. So you're going to see coming soon there if you try to go to the website in the next week or so. But that's www.mycornerstonewealth.com. And you could look us up on Facebook too. We have a Cornerstone Wealth Management site on Facebook as well. And I'm sure that Jill can make that stuff available to you via her page when we get done also. But would love to field any questions or help you guys out as much as we can.
All right, well, thank you two gentlemen. I know you're super busy right now, so I appreciate you joining us, and I am going to save the recording and post that as well to make sure that people who are working, we have several people working in hospitals and things like that right now. So I will make sure that they have access to this call as well. And I so appreciate your time and your expertise today.
Thank you, Jill.
Yeah, very welcome. Thank you.
Thank you.
Thank you.